How's it going, guys? It's your boy Mike from Seattle. And right now I'm with Caleb and Chuck. Fellas, introduce yourself. Who's who?
Caleb, Chuck.
So Caleb and Chuck are students of the Cody and Christian Multifamily Strategy course. As you guys know, Cody and Christian have a whole bunch of units. They're trying to make people like me just feel bad about ourselves. Caleb and Chuck have taken it to an all new level. Now, last I checked, you guys were both 19 years old. Has anybody gotten any older yet?
Yeah, I got a little older. I'm 20 now.
Okay, 20 and 19. And you guys own how many units?
We're at 28 units today.
Okay, so for those of you guys out there who are flabbergasted how a 19-year-old and now an ancient 20-year-old could somehow manage to buy 20 different units, don't worry, we're going to talk about it right now. So the first thing I want to do is I want to talk with these two guys about how they found each other, because they are business partners, and that's a little bit rare. Cody and Christian do it well, but most people don't. So real quick, guys, give us your history. How'd you meet? What made you guys decide to go into business together?
Well, just how we met, it was what was it? First day of high school.
Yeah,
we were both in a class we weren't supposed to be in. It was 3D design. I thought it was computers.
Yeah, I didn't even know I could pick that class. I just left my thing blank, and then we got put next to each other the first day of high school.
Okay, so first day of 9th grade?
Yeah.
Okay, and you guys have just been boys ever since, huh?
Yeah, and then kind of when COVID hit, we were just hanging out still, and then his mom gave us the book Rich Dad Poor Dad. From there, we kind of just started going on the path together, and then boom, a few years later, we're here.
Okay, so early on, his mom gave you guys, so Chuck's mom gave you guys Rich Dad Poor Dad, and you both read it as 9th graders or 10th graders or something?
Yeah. Well, I was just bored, so I was just reading a bunch of books, and then she's like, "Oh, this book's good." I read it, and then I'm like, "Oh, Caleb, this is sick."
Yeah, and then I read it. I'm like, "Oh, I'm like, what's going on?" And then it's kind of kept going from there.
Yeah, so I mean, obviously, first thing that I think of is it's pretty rare for somebody that young. I mean, we're talking 15, 16, maybe years old, to be interested in reading a book about finance. I remember when I was your guys' age and screwing around in high school, I was playing a lot of World of Warcraft, some Call of Duty and Halo 3. But you guys, I mean, you must have done right. Well, what'd you do for fun? You guys play any sports or what? I mean, it wasn't just all finance.
Right.
Yeah, like I was just playing basketball all the time, then COVID hit, and I just didn't have anything to do, and I just kind of felt like a loser because I was just sitting on my ass all the time.
Right,
so
right.
I just started reading stuff.
Yeah, kind of the same case for me. I was playing baseball through high school, COVID hit, and just didn't have anything to do. And I'm like, fuck, I just want to sit on my ass all day and play video games. Got to kind of do something.
Right. Yeah. Well, okay. I mean, in all fairness, that actually makes sense. So when I was in high school, this was back before the pandemic. I'm quite a bit older than you guys. We actually got to go to high school. Zoom hadn't even been invented yet. That's how old I am. YouTube was like 2 years old. So I can understand how you probably got bored of being at home looking for something to do. So it's impressive that you guys decided, hey, rather than smoke pot and try to play Russian roulette with teenage pregnancy, you guys decided to freaking, bust it out and do Rich Dad Poor Dad instead. So that's cool. So you read Rich Dad Poor Dad. That got you started in your journey or in your curiosity about financial freedom. What happened next? How do you go from Rich Dad Poor Dad to 28 rental units?
Yeah, so that we were juniors in high school. We were kind of like, we were both in the assumption like, man, maybe it would be cool after we go to college, all this stuff, get high paying jobs. Then we can start buying rentals down the line.
Mm-hmm.
Finished out high school. We're both going to junior college. We're kind of like, this sucks. And then we started trying to kind of get proactive with the whole thing again. And then through a bunch of networking, a loan broker in San Diego introduced me to Cody, then just bugging the crap out of him with questions. And that was right as he started up his mentorship. So we kind of got in at the ground floor, joined that, and then that gave us the confidence to drop out of college.
Sure. Okay, so you guys met up with them. You met Cody. Did you start taking his course, or were you being mentored to him prior to the course?
It was just when the course started. It was a lot different setup it is now, but yeah, we just started getting mentored by him kind of as soon as he started that stuff up.
Yeah, it was before the course really existed. It was just the mentorship.
Yeah, it was just like
one call every 2 weeks.
Yeah.
Okay. So you're talking with him, you're asking questions. Now, at this time, I guess I'm not sure exactly how long, but I know Cody met Christian. He already had like 30 plus units at that point. So did you meet Cody and then Christian came in later, or did you meet both of them?
I think it was kind of simultaneous. I think they they just started it up together.
Okay. So you meet Cody and you're inspired by what he's doing and how he's managed to get 30 plus rental units. And so what did you do from there? How did you learn his system, steal it, take from it, borrow? What'd you do?
Yeah, so it started off, we had those Zoom calls every 2 weeks, and we were still in junior college at the time. We're like going to that for like a month. We're like, gosh, the junior college route sucks. So we're like, worst case scenario, we can always come back. We decided to drop out of junior college. And then the whole time, it was the course now, you can just go into it whenever. There's 3 Zoom calls a week. But at the beginning, it was like, if you missed a Zoom call, you went a month without seeing them. So it was just kind of taking whatever we learned and applying as much as we could. For us, Cody goes a lot of the owner route up in Washington. For us, we didn't want to buy in San Diego. It's pretty tough here.
Right.
So we decided just look towards different states, and we ended up settling on Texas. So just called a ton of brokers.
Yeah, just looked at so many deals.
Yeah, it was an insane amount of deals before we got our first one.
Now, so a lot of people on my channel kind of know that I am an out-of-state investing guy. I talk a lot about investing at a distance, long distance real estate investing, out of state, all the different names for it. And many people are attracted to that type of investing because, like you guys, they might live in extremely overpriced and very bad landlord law, California, Seattle, New York, wherever it might be. So you guys said to yourself, we're not going to invest in San Diego or California. We want to go long distance. You settled on Texas. Why specifically Texas?
You want to talk about Nevada a little bit?
Yeah, I mean, so at first we looked at Nevada because it was in close proximity, and it was also landlord friendly and all those great things, population growth. But there's just not enough inventory at all, because we're trying to look at a ton of deals, and when there's only 2 deals on the market when we're trying to look, it just doesn't work out.
Yeah, we were looking up by Reno in a little submarket called Fernley, Nevada. It's about 30 miles east of Reno. Or so we were just pounding, like looking there, like calling owners there. We're like, gosh, it's just not enough volume to look at. Like, there's 2 deals in the market, neither of them will seller finance. I'm sure anybody who's looked at this town has seen them, over 100 people. So it's like anything new that pops up, there's just nothing for us to look at. And so we kind of just decided, hey, we either got to just keep banging our head against the wall here, or we need to pivot. And then so we decided we were going to pivot. We're like, okay, we're next. And we're like, okay, whereas a ton of inventory, they love landlords, and it's growing like crazy. And it came down to either Texas or Florida. And the whole reason we chose Texas is it's halfway closer across the country.
I suppose that's true. It's a shorter flight if you got to get on the plane and go out there and visit your rentals.
Exactly.
Okay, so you decided on Texas because you wanted specifically to have more deals to compare against each other, right? So you're looking at Nevada, and this is actually good information for people out there who are looking at what Zuber, One Rental at a Time, talks about as a buy box. Well, in order to look at a specific property and figure out what average is so that you can know what a good deal versus a bad deal is, you have to have enough properties that you can start to make your assessments of all of these properties. If you look at 50, you can figure out where the good ones and the bad ones are. If you look at 2, they could both be good, but most likely they're both bad. That's why they're not selling.
Yeah.
Okay, so you go to Texas because they have a ton more inventory. Now, when you say you are looking at these deals, what specifically are you looking for? I think what people want to know is, great, you're looking at multi-unit deals. What says to you that that's a good deal? What are the parameters you're trying to get in?
Yeah, so the first thing is, a lot of people didn't want to seller finance back then because interest rates were 3% when we were looking. It's like, great. Yeah, we're gonna have to battle with this. So the first thing we defined was people that would seller finance, because most of the time their deals are overpriced. But as we learned from Cody and Christian, price isn't the most important thing. And so the biggest thing we were looking for was an owner that's open to seller carrying and would get creative on the terms. And then that equal to a better return on the back end. So we looked for 10% plus cash on every deal we looked at.
Okay. So number 1, you want someone who's willing to seller finance.
Yep.
Number 2, 10% cash on cash return on the back end.
Yeah.
Those were your 2 stipulations to get started with, right?
Yep.
Okay. So now, as you mentioned earlier, especially back then, and I remember, it was very tough to get seller financing because nobody, I mean, like if interest rates are 3%, maybe 4.5% if you're an investor, dude, just go borrow money from a bank. I don't want to go through the hassle of seller financing to somebody. So how did you find people? I mean, did you just call 1 million people? Did you have a marketing campaign, letters, mailers? What were you doing?
Honestly, it was along the lines of calling 1 million people. I called so many brokers in the state of Texas, and finally we came across a guy. His deal was pretty overpriced, but there was a ton of rental upside. He was a mom and pop owner, and just found out price is the most important thing. He was open to owner carrying. That was after probably like 500 calls, maybe 500 plus deals looked at.
Wow.
And then finally he was open to it, open to being flexible on his terms, and then kind of negotiated that one from there.
So when you're looking for these deals, where are you finding them? Like LoopNet, where are you finding them?
Yeah, that's where we kind of started off. We'd go look at LoopNet, Crexi, maybe Realtor.com has a few, Zillow might have a few, but kind of start off, it's like, hey, this property looks cool. It's in, as Zuber calls it, the buy box. We can go
Right.
after that. It's like 5 to 25 units. And then so we'd call on those. And then even if wouldn't seller finance, it's like, hey, do you have anything else this time? And even if they didn't, we kept in touch with them for the future. So when they did have seller financing deals coming in the line, we would be the first call.
Okay, so so for people who don't know, loopnet.com is a website similar to Zillow or realtor.com. And what it does specifically is it lists commercial properties. So that's 5 units and above, or, gas stations and other random commercial properties, strip malls.
Yeah.
So you're going on LoopNet, you're looking in cities in Texas for 5 to 25 unit buildings. And you're hoping and you're calling on every single one of them, right? And and then seeing if they're offering seller financing. So you're calling on 500 plus deals that you looked at.
Yeah.
To get one guy who said, okay. What did that conversation go like? Like when you talked to this, did you talk to the broker or directly to the owner?
Yeah, we talked to the broker and it had been listed for, I think it was 150 to 200 days. So it had been sitting for a good chunk of time. And just kind of called him with the script, found out the guy just really wanted his price. He was getting just all these lowball offers and he just was tired of it. He just wanted somebody to hit the 900,000 mark for him. And we're like, okay, that's not an issue. Will he seller finance? She's like, yeah, I think he'll be open to that. So we kind of started hammering down the terms. He had some other stipulations with interest rate, but we worked everything out and that's kind of how that one went. And then got under contract and then figured out some stuff we didn't know and got that one closed.
Sure. So tell me about the very first deal specifically. How many units was it? And things like, were they rented? Was it currently occupied? Did you have to repair it?
Yeah, it was 100% occupied. It's 10 units, 10% down, 4% interest after 7 months or 6 months.
Yeah, 6 months of no payment on the mortgage.
Okay, so let me get this straight. I'm going to explain, make sure everybody understands. So it's a 10-unit property. It's fully rented out. He wanted it $900,000 purchase price with a 10% down payment. So you guys had to come up with 90 grand, but you get 6 months of no payments, right? Okay, so, and if it's fully occupied, I assume you didn't have any plans to remodel it day one, right?
Nope.
So you bring in 6 months worth of rent before you have to make your very first payment. So you financed to this guy $810,000. What was, and if you guys don't want to share specific numbers, you don't have to, but like, what was your monthly payment to him? What was it? What did it come out to when you start?
Yeah, don't have it in front of us, but it's when we do start our payments, we actually start in March as our first one is 4% interest on a 45-year AM. And the kind of the reason that came to be is the guy he wanted a flat interest rate the whole time. I was originally asking to do interest only into an amortization loan. He's like, no, I just want to keep it simple. Like, this is the last thing he needs. What do you need to get it done? I'm like, well, we don't really want to raise extra money for reserve for our first deal. So how about we just do that 6 months, no payments, build a $30,000 reserve, and then start 6 months later.
So he agreed to 45-year amortization. And for those people out there who don't understand what that means that you took your $810,000 you're financing with him and broke it down over 45 years worth of payments. Is there a balloon payment at any point?
Yeah, we got a balloon payment after 5 years on that one.
Okay. So the reason why they did this deal is they're looking at it from a cash flow perspective. I need to keep a low enough payment so that my cash flow I bring in from the rentals gives me enough spread that I make money and can set aside money for more projects, more deals. So they want to get that monthly payment as low down as possible. However, they don't get to actually do it for 45 years. 5 years from now, they have to come up with an exit strategy, whether that be sell, refinance, or renegotiate more terms with this guy. Maybe he's like, you know what? I kind of like keeping some of this money flowing in, and maybe you just start to pay more. So real quick, tell me, what's the plan? What's the exit strategy?
Yeah, and that one, the exit strategy is go through refinance in 5 years. That's the plan. We could sell it. And we're also, there's a little creative strategy. Another one we're implying is there's an extra acre in the back of the property. So we're going to sell that off and then get more debt pay down from that. So it'll be even easier to refi.
So 150,000 extra equity.
Yeah.
Wow. Well, that's great. That's pretty fantastic. So, okay, real quick, then let me know, what are all of the 10 units exactly the same, or are they different?
Yep. They're all 2-1s.
And what do they rent for approximately?
They're about 800.
So around 800 times 10. So that's $8,000 a month. And you said your monthly payment to him when it starts is what?
It's 4% interest on a 45-year AM. I don't have the numbers.
I think it's like 3,400. I think it's around there.
Okay. So you took $8,000 a month for 6 months up front. My math's not great, but I think that's approximately $48,000 that you were able to bring in without having to make any payments. And then moving forward, you're probably bringing in $8,000 a month approximately. But you're only paying out $3,500. That's a pretty good spread. That's a $4,500 spread. Now, but a lot of people would say, well, yeah, but you still got to pay your property manager, right? So what are you doing with a property manager? How does that work?
Yeah, that's a great question. So for us, we're doing third-party management on that one, and the vetting process for us on that, because I know a lot of people, that's one of the biggest bottlenecks with out-of-state investing is, oh, what am I going to do for property management? It's a really daunting thing if you haven't done it before.
Mhm.
But I think the most important part, what we learned is you just have to vet the property managers and ask for referrals, and how that kind of, we partner with our property management company down there. And it just calling so many brokers. I was kind of like, hey, who's your property manager down here? Who's your go-to? Who have you heard the best things about?
Right.
And one name just came up almost every single time. So
Right.
after we
And how many times do you think you probably asked that question?
probably 10 brokers or more.
Okay. And you start to see who sounds good.
Yeah. And then I was like, okay, I got to call these people, call them, kind of figure out everything they were doing, talk about the plan for the property, and then decide to go with them. They were 8% management fee. I know it's usually ranges about 5 to 10. So they were about right in the middle.
No, 8% is good. A lot, at least for on single family homes, you'll see 10 to 12. Obviously, probably if they're managing more units and it's all consolidated in one area, they might start to knock the price down a little bit. That makes sense, but 8% is fantastic. So my question for you guys, were the properties, when you purchased this first deal, were they currently being managed by the owner or by a separate property management company?
Yeah, that's how all of our deals have been, just mom and pop owners. That's why there's so much upside. It's just because they're not pushing rents, they're just sitting there, it's paid off. They're like, why not? I don't want to lose tenants.
Yeah, they're
Okay.
managing like a hobby. It's
Yeah.
not a business to them. It's like they have a relationship with each and every tenant. So like, let's say tenant A, like mom says his mom passed away, can't pay the extra rent, has to cover funeral expenses. It's like, if you're like a friend with a guy, you're not going to raise his rent. But if it's a property manager running like a business, it's like, just run more efficiently. You get the max upside for rents.
So for 2-bed ones in Texas, is 800 below rent? Is that at rent, or is there room for these to go up?
We're probably about market there now. We just got them up. But yeah, down in McAllen, that's probably about market right there.
Yeah.
Okay, so you're happy with where they are right now. Obviously, over the next several years, they'll probably creep up a little bit here and there between now and year 5 when it's time for the exit strategy. But this is really interesting. So for those people out there who are watching who are interested in what these guys have done, it sounds like they did a ton of legwork. I mean, I'm imagining you guys probably spent weeks, if not a couple months, calling on all these properties before you finally found the one.
Yeah, probably about 6 months.
Wow.
I'd say.
Yeah.
Wow.
We had a couple deals fall through. That was just tragic. It was
Yeah, I
horrible.
mean, that's kind of like, yeah, really frustrating. We had a couple like 2 months and 4 months in instead of the 6, where it's just stuff blew it up last second. And it was just like, gosh, it can get frustrating sometimes for sure.
Right. Okay, so question for you guys, because I think I missed this earlier. Probably one of the things that people are thinking right now are, okay, great. They found a seller finance deal. They're putting 10% down. That's actually really good. A lot of people want like 20% down. 4% interest rate's not bad at all. 6 months before they have to make a payment. That's fantastic. But how did you come up with $90,000? And then there must have been some closing costs. I'm imagining it was probably closer to $100,000 to actually do that deal.
Yeah, so I mean, for us, 90,000. Chuck and I were broke college students, had about $300 to our names each. So don't really have the money for that. So how we did it, we just kind of, everybody in our network just kind of reached out to people locally doing San Diego. Actually met up with 2 guys. They decided to invest in the deal. They gave 30,000 each. After we went through a meeting with them, just got grilled by them for like an hour and a half, just every single question you can imagine. And after that, they decided to kind of come on the deal with us. And then for our final investor, we're like, gosh, where do we go now? Don't really know. And so actually posted on Facebook, just kind of saying like, hey, I have an opportunity if anybody be interested, 10-unit McAllen, Texas. And a lady actually reached out to us and she was super interested in the deal, and she ended up being our final investor.
And there were actually he paid the closing costs. It was only like a $2,000, but he paid them.
Okay, well, that's nice. That's actually good. That's not always how it works, but that's fantastic. I've done a few seller finance deals myself, and I paid the closing costs, and they're usually pretty cheap.
Yeah.
But yeah, $2,000 is really good because I spend $2,000 and think that that's good on a house, much less 10 units. So you raised $90,000 via private investors. Can you share with us what the structure looks like with those private investors? When do they get paid back, or how are they getting paid?
Yeah, so it's just a joint venture that they own a part of the LLC, and then how they're getting paid is they're getting 8%, 8% a year on their money,
Okay.
and
Okay,
then
that's good.
and then after 5 years they get a 1.5 buyout.
Oh, so you pay them back $45,000 each.
Yep. Yeah.
So okay, so at 5 years, you owe The remaining.
It's actually after 7 years.
What'd you say?
Yeah, it's after 7, and
7.
after 7 years, yeah, we owe them 45 grand each.
Okay. So you've got 7 years to pay them back 1.5 times their money. In the meantime, you're actually paying them 8%, but none of that's going to the original principal that they lent to you. You're just straight paying them 8% interest a year. So is that in monthly payments, or once a year you cut a check for 8%?
Yeah, we do it in monthly. We'll start next month. It'll be in monthly payments.
Oh, so did you push off a 6 months period for them too?
Yep. So we could just keep that reserve going full.
You freaking studs. I like it. Okay. And this is so creative. So for people out there watching, who say, I can't buy a property, it's too difficult to buy in 2023. It is. It's very hard to buy. 2022, because of interest rates and high prices, was the second least affordable year in the last 53 years. The only year that was worse was 1980. And what's interesting is that's actually a complete flop, because 2021 was the second most affordable year in the last 53 years. The other one was 2010. And so people are panicking because they can't figure out how to structure deals. But this creative financing or owner carry seller financing, all the different names that it goes by. I mean, this is a fantastic deal, just doing the numbers in my head. And I really love how you convinced everybody, yeah, we don't even want to pay you for 6 months. We're just taking that money. We're putting that as reserves. Okay, so you do this entire deal. You get your first 10. And what were they? They were 5 duplexes. Was that what it was?
Yeah, it's 5 duplexes side by side.
All right, I remembered that part from your story last time we chatted. So 5 duplexes side by side. I love duplexes. They're freaking fantastic. More likely, well, I take this back. The common thinking is that people like to stay longer in single family houses or like duplexes than they do in large apartment buildings. However, I've been chatting with people in large apartment buildings who say, you know, that's a misconception. So maybe it's not common knowledge. But my question for you guys, how many of these tenants are long-term tenants? Do you think they're going to stay for a while, or are you preparing for any type of rollover coming up?
Yeah, so all 10 were actually pretty long-term tenants. 1 left because it was month to month. So we decided we were going to go and increase rents day 1. Just a $50 increase to get it to the 800. And they were like, we just don't want to do that. So they left. So we're in the process, turn that unit a little bit, filling that vacancy. But other than that, they all were okay with it and stayed.
Sure. Okay. And I think I've asked most of the questions on this deal. I want to go back to property managers for just a second. So you said that you spoke to a ton of different brokers. And then while speaking to those brokers, you started to recognize the same name popping up over and over again. Eventually, you call this property manager. Now, how did you do your due diligence with them? When you called, what was the interview like? What did you ask them? Tell me about that.
Yeah, I was kind of just finding out how many units they manage in the area, how long they've been doing it. It was a couple hundred in the area. They've been doing it for a while. And it's kind of what they saw as the plan for the property, where they saw market rent at, because we had gone over some data too. Just want to see if we were all on the same page with everything. And kind of when everything was on the same page, and it's like, hey, going forward, it's like we can turn these units as they come up. But right now, these tenants are paying almost market. Let's go in and get it to market, and then just keep it going from there. And just then we were working on selling on the acre. Just made sure they knew that. They were like, that's a great idea, and kind of agreed with everything.
Cool. That is very interesting. Well, fellas, I appreciate you taking the time to do this video. We're actually going to do a second video, so we'll see you guys there.